When the cost to produce your main product jumps 30% in a single quarter, you you just stop fighting the math and rent your entire factory out to AMD instead, which is exactly what happened today. You are listening to Earnings Unscripted, where we unpack what really happened in the numbers. Today is March 2nd, 2026, and we are diving into Riot Platforms, ticker RIOT, and their honestly totally wild Q4 2025 results. Miro, it is a fascinating pivot. What stood out to you first?
Yeah, the pivot really is the whole story here. Look, the headline numbers are pretty jarring on the surface. Total revenue dropped 15% from last quarter, landing right around $152.8 million. But the real shocker is the bottom line. They swing from $104 million in net income in Q3 to an implied net loss of roughly $690.8 million in Q4.
Just to interject real quick, and as always, this is not financial advice, just our personal opinions. But wait, a nearly $700 million loss? How does that even happen without the market completely panicking? Because, the stock had a brutal quarter overall, down about 35%. But today it actually ran up over 5% before the bell to 1643. And then after hours on this huge loss, it traded completely flat, barely moved a percent.
Because it is a ghost or an accounting phantom, mostly. The street knows it is heavily driven by the new FSB rules. Riot has to mark-to-market their Bitcoin on the balance sheet now. So when the price of Bitcoin dips during the quarter, they take this massive non-cash depreciation hit. It is not actual dollars flying out of the corporate treasury.
Oh, okay. So it is just a paper cut, basically.
Exactly. But what is actually flying out the door are their mining margins. The global hash rate surged to record highs, so it's harder to mine. Riot's cash cost to mine a single Bitcoin shot up to $60,628, up from $46,000 just a quarter ago.
Jeez, that's a huge leap in just 90 days.
Yeah. So their mining gross margins just collapsed. They went from 59% down to 39%. You can see why they're throwing in the towel on pure mining and leasing their sites out instead.
Which kind of brings us to the most human part of this whole report. They outright admitted they get 2.5 times more gross profit per megawatt renting space to AMD than they do grinding it out for Bitcoin. So they're essentially becoming like a high-tech real estate play overnight.
Mm-hmm. The AI data center economics are just too good. And the crazy part is they're pulling it off because of an acquisition they made years ago. They own their own internal engineering company. So while everyone else is waiting 2 years for electrical switchgears, Riot is building their own. Their engineering backlog just exploded 46% quarter over quarter to $224.6 million.
That is just wild to me. The ultimate bottleneck in AI is not even the chips right now. It's literal power equipment. And they just happen to have a factory for it. All right, let's get into the details on how they're actually financing this AMD transition.
Yeah, so this is where it gets highly technical but genuinely elegant. The new CFO, Jason Chung, is basically pulling off it is a masterclass in project finance here, because normally if you go to a bank to fund a massive data center build, the risk is huge.
Wait, let me guess. You get slapped with a giant construction premium, right? Because nothing is built yet and banks hate uncertainty.
Exactly. You pay high interest on the whole facility. But what Riot is doing is actively splitting the risk profile. They have this first 25 megawatts, and that is fully backed by AMD's 10-year lease. AMD has an A-grade credit rating. It is pristine.
Oh, I see. So they take AMD's credit score to the bank to get cheap debt for that specific chunk.
Spot on. Jason Chung literally explained on the call, quote, "By separating these two distinct credit profiles, what we are able to do is avoid paying a blended construction premium across the entire facility," end quote. They lock in guaranteed cash flow for tier 1 lending on the finished part. And then they just use a delayed draw facility for the riskier 75 megawatt expansion. It is just incredibly smart structuring.
It really is. It feels like they are finally operating like a a traditional digital infrastructure REIT instead of just a crypto mining outfit. Which brings me to the wildest part of the balance sheet. Did you see how they actually paid for the real estate?
Yeah, that blew my mind a little bit. We always hear companies talk about holding Bitcoin as a reserve asset, but Riot actually weaponized it for physical sovereignty. They literally liquidated about 1,080 Bitcoin straight out of the treasury. That's roughly $96 million just gone.
Just a sanity check, they used that specific cash to buy the ground lease, the actual dirt sitting under their Rockdale facility.
Yes, the entire 200-acre site. They bought it out from under the legacy lease terms. Jason Les made a point that this single move wiped out roughly $130 million in estimated future rental payments. But financially, honestly, the rent savings are secondary.
Really? Why? $130 million is massive.
It is, but it's about absolute developer control. You can't easily pitch a multi-decade AI project to a creditworthy client if you don't even own the land your switchgear sit on. It's a massive counterparty risk for a company like AMD.
Which makes total sense. You're not going to park billions of dollars of delicate AI servers on rented farmland. It's just fascinating. They're literally trading digital gold to buy physical dirt.
Pretty much. And when you look at Colin Yee stepping down and Jason Chung fully taking the CFO reins, the whole management vibe just screams heavy debt markets and corporate finance now. The era of just plugging in more ASICs and praying the hash price stays high is dead. They told the street exactly how to value them moving forward, rotating entirely to an enterprise value per megawatt model.
Right. The metrics completely shifted. So they basically survived the cost to mine explosion by rewriting their entire corporate DNA. But the big question is, where does this leave them heading into next quarter? Are they actually going to find more AMDs out there to fill all that capacity?
Well, that is the exact bet they are making right now, because they are absolutely hunting for more top-tier tenants. Management laid out their main goal over the next 12 months, which is getting 1 gigawatt, literally a full gigawatt of capacity, developed at their Corsicana site.
From crypto cowboys to high-end commercial landlords, it is such a wild shift.
It is, but it is necessary. And Jason Les was extremely confident about it. During the Q&A, he outright said, quote, "We are absolutely targeting additional announcements in 2026, end quote. They believe they have the right setup. But look, it is a probabilistic game at this point. They are betting the next few quarters entirely on execution. They still have to deliver the remaining 20 megawatts for the second phase of that AMD lease by May 2026.
Wait, hold on. So they have to actually finish building the house before they can start inviting more guests.
Exactly. It is all about proving the model. The entire tech cycle is screaming for power, right? But the market is not just going to hand Riot a premium digital infrastructure valuation overnight. They want investors to judge them on enterprise value per megawatt now, instead of Bitcoin metrics.
Yeah, which makes sense if the AMD lease brings in, 2.5 times the profit of mining? But you still have to show that AMD was not just a lucky catch.
Precisely. If they land another A-rated, credit-worthy tenant, they officially detach from the chaos of Bitcoin mining margins. They become an energy toll booth for the AI supercycle.
Which honestly sounds like a much less stressful business model to run.
Significantly less stressful.
Right? So I guess the big story to watch next quarter is not how many coins they squeezed out of the machines, but who else is signing a lease to move into the neighborhood. Anyway, if you want these earnings unscripted chats to just naturally show up in your feed, go ahead and follow the podcast. Just a quick reminder, this show was built with the help of AI to digest those massive financial filings so we can actually just talk about them. We would love your feedback or ticker requests, so drop us a line at earningsunscripted@datamadness.ca or hit the X link in the show notes. Thanks for hanging out, and we will catch you after the next bell.
See you next time.